Hi, Tim Kerin here from Mortgage Choice in Kingsley. I think it's important at the moment for something a lot of people are thinking about to discuss the difference between a fixed rate loan and a variable rate loan. So if you're wondering, for example, whether you should fix, if you're currently on variable and you should fix, or you're already on a fixed rate and you're wondering whether you should break that fixed rate and refix because fixed rates are really low at the moment, perhaps this will help you figure it out. So I'll start by describing a variable loan. In general, with very few exceptions, a variable rate home loan is typically a 30-year loan term with a rate that can change whenever the lender wants to change it, but typically changes when the industry shifts rates or when the Reserve Bank changes rates. Lenders typically respond to that, although they do change their rates, their variable rates, outside of the Reserve Bank monthly rate cycle whenever they need to, and they might change rates on different variable products at different times to compete for different types of businesses with each other or readjust their own portfolios. So a variable rate, if you get a variable rate loan, that's a rate that can change at any time, and if the rate changes, then your minimum required repayment changes accordingly. A fixed rate loan, by comparison, is essentially the same sort of loan contract with an additional section that says for the first X years, it might be 3 or 5 or 1 or 2 or 4 or even 10. For the first, let's say 3 years, the rate will be this, and it won't change for those first 3 years, and therefore your repayment for those first 3 years or however many years won't change. It'll be the same based on that fixed rate. At the end of that fixed term, it will revert to a variable rate loan for the remainder of the, for example, 30-year term. So the chief difference between a fixed rate loan contract and a variable rate loan contract is really that additional clause about the fixed rate. Other than that, they're largely similar in terms of how the whole thing is done and how long it lasts. A fixed rate loan realistically is a variable rate loan that's fixed for the first few years and it's variable after that unless you do something about it. Now, that's not to say that there aren't a lot of differences that come along with the fact that it's fixed. So when you get a fixed rate, it also restricts your behaviour in a few ways. Number one, typically lenders don't let you repay a loan that's on a fixed rate period as quickly as you like. They'll typically restrict you, which is different to how a variable loan works. On a variable loan, you can typically pay it off as quick as you like without any penalty. On a fixed rate loan, you might be restricted to, for example, $10,000 a year worth of extra repayments above the minimum, or $20,000 or $30,000 per fixed rate period. Different lenders have different rules. In some cases, it's a percentage of the loan amount that you can repay each year. So if you go into a fixed rate loan contract, you need to be cognizant of that limitation and see if that's the sort of thing that's going to be an issue for you. Because if you go beyond that maximum repayment, then the lender is able to charge you a fixed rate break cost, a penalty for paying it off too quickly. The extreme version of that would be selling the property and paying out the entire loan, or refinancing to a different lender. That's way more than the extra $10,000 a year or whatever that rule is. So you need to be comfortable that during that fixed rate period, it's highly unlikely that you're going to do anything to change the loan or do anything to pay it off too quickly, e.g. sell the property or refinance or win lotto and pay a big chunk of it off or something like that. So that's the first thing. If you do make extra repayments during a fixed period, with most lenders, most of the time, you can't redraw that extra. If you do get ahead of where you need to be, you can't access those funds until the fixed period ends. Once the fixed period ends, then you have access to those funds. In the case of a variable rate loan, typically if you put extra money in, you can redraw it again. So that's another freedom that disappears with fixed rate loans. The third one is typically that you can't link an offset account to a fixed rate loan. Some lenders have exceptions to that, but it's not common to see a fixed rate loan that's a good deal for a fixed loan that also allows you to use an offset account. There's a couple of exceptions, but generally speaking, there's that restriction as well. So the way a lot of people get around that, if they want a really good fixed rate, is to fix most of the debt but have a smaller portion of it as a variable rate loan so that they can make as much extra repayments on that portion as they like, redraw them again and link an offset account to it. So that's the key difference between a variable rate loan and a fixed rate loan. It's an additional section of the loan contract that stipulates a lot of restrictions for the first few years in exchange for your rate not changing. Now, right at the moment, fixed rates are a lot cheaper than variable rates, and that's only been the case for the last few weeks. When the Reserve Bank met for the second time in March and slashed the official cash rate down to 0.25%, about a third of the lenders we've got access to, it's getting closer to more like a half now actually, have dropped their fixed rates dramatically. So I have a lot of customers now who are on an existing variable rate or on an existing fixed rate who are strongly considering changing to a much lower fixed rate, either at their existing lender or at a new lender. In the case of people on an existing variable rate, switching to a fixed rate loan now looks like it's going to save them a lot of money because of the rate difference. And I'm being asked whether I think rates will go up anytime soon, and I don't know the answer to that, and I'm not going to speculate. But I think if you don't think rates are going to go up anytime soon, then getting a fixed rate, switching your existing variable loan to a fixed rate is a decent chance that's going to save you a lot of money, and we should talk about it. If you're already on a fixed rate loan, but that rate is a lot higher than what you can see you can get now, yes, you could save a lot of money, but that is a classic example of the fixed rate break cost I was talking about. If you want to break that fixed rate loan in order to refix it at a lower rate, you'll get charged a break fee. So if you want to go down that path, the first thing to do is find out how much that break fee is going to be and factor that into your thinking. In the case of staying at the same lender, you need to actually come up with that money somehow, or borrow it. In the case of going to a different lender, you can borrow it as part of that process. I hope that helps. I hope that is something you can factor into your thinking, and if you need to discuss it further, please get in touch with me. Thanks.